Since graduate school, I've heard a continuous stream of theories about stocks. Each one is more misguided than the last. The following statements are the 12 silliest things people say about stock prices. I present them here, hoping you'll dismiss them from your mind. Silly statement number 1. If it's gone down this much already, it can't go much lower. I bet the owners of Polaroid shares were repeating this very phrase after the stock had fallen a third of the way down from its high of 143.5. Polaroid had been a solid company with a blue chip reputation. When earnings and sales collapsed, a lot of people didn't pay attention to how overpriced the stock was. Instead, they continued to reassure themselves that if it's gone down this much already, it can't go much lower. The fact is, Polaroid did go much lower. This great stock fell from $143 to $14.5 in less than a year. Only then did "it can't go much lower" turn out to be true. The truth is, there's simply no rule that tells you how low a stock can go. Silly statement number 2. You can always tell when a stock has hit bottom. Bottom fishing is a popular investor pastime, but it's usually the fisherman who gets hooked. Trying to catch the bottom of a falling stock is like trying to catch a falling knife. It's normally a good idea to wait until the knife hits the ground, sticks, vibrates for a while, and settles before you try to grab it. Grabbing a rapidly falling stock results in painful surprises. You almost always grab it in the wrong place. Silly statement number 3. If it's gone this high already, how can it possibly go higher? Right you are, unless of course you're talking about a stock like Philip Morris. Philip Morris is one of the greatest stocks of all time. If you bought Philip Morris in the 1950s for the equivalent of 75 cents a share, you might have been tempted to sell it for $2.50 a share in 1961. The theory being that this stock couldn't go much higher. 11 years later, with the stock selling for 7 times the 1961 price and 23 times the 1950s price, you might again have concluded it couldn't go any higher. But if you sold it then, you would have missed the next 7-bagger on top of the last 23-bagger. There's no arbitrary limit on how high a stock can go if the story stays good, and the earnings continue to improve, and the fundamentals don't change. Silly statement number 4. It's only $3 a share. What can I lose? How many times have you heard people say this? Maybe you said it to yourself. You come across some stock that sells for $3 a share, and you're thinking, it's a lot safer than buying a $50 stock. I'd worked in this business for almost 20 years before it finally dawned on me that whether a stock costs $50 a share or $1 a share, if it goes to zero, you lose everything. The point is that a lousy cheap stock is just as risky as a lousy expensive stock. Silly statement number 5. Eventually, they always come back. People said RCA would come back. 65 years passed and it never did. When you consider the thousands of bankrupt companies, the solvent companies that never regain their former prosperity, and companies that get bought out at prices far below their all-time highs, you begin to see the weakness in this argument. Silly statement number 6. It's always darkest before the dawn. It's very human to believe that when things have gotten a little bad, they can't get any worse. For example, people who invested on the basis of freight car deliveries were amazed when business dropped from a peak of over 95,000 units delivered in 1979 to a low less than 45,000 units in 1981. This was the lowest level in 17 years, and nobody imagined it could get worse. However, from 45,000 units, it dropped to 17,500 in 1982, and then to 5,700 in 1983. This was a whopping 90% decline in a once vibrant industry. Sometimes it's always darkest before the dawn. But then again, in the stock market, other times, it's always darkest before pitch black. Silly statement number 7. When it rebounds to $10, I'll sell. Very often, downtrodden stocks never return to the level at which you decided you'd sell. In fact, the minute you say, if it gets back to 10, I'll sell, you probably doom the stock to several years of teetering around just below 9.75 before it keels over to 4 on its way down to 1. This painful process may take a decade. All the while you're tolerating an investment you don't even like because some inner voice tells you to get $10 for it. Whenever I'm tempted to fall for this one, I remind myself that unless I'm confident enough in the company to buy more shares, I ought to be selling immediately. Silly statement number 8. What, me worry? Conservative stocks don't fluctuate much. 2 generations of conservative investors grew up with the idea you couldn't go wrong with utility stocks. Then suddenly, there were nuclear problems and rate-based difficulties. Stocks like Consolidated Edison lost 80% of their value. Then just as suddenly, Con Ed gained back more than it had lost. There simply isn't a stock you can own that you can afford to ignore. Silly statement number 9. It's taking too long for anything to ever happen. If you give up on a stock because you're tired of waiting for something wonderful to happen, then something wonderful will begin to happen the day after you get rid of it. Most of the money I make is in the 3rd or 4th year that I own something, although sometimes it takes longer. If all's right with the company and whatever attracted me to it hasn't changed, I'm confident that sooner or later my patience will be rewarded. Silly statement number 10. Look at all the money I've lost. I didn't buy it. Regarding someone else's gain as your personal loss is not a productive attitude for investing in the stock market. The worst part about this kind of thinking is that it leads people to try and play catch-up. They buy stocks they shouldn't buy under the delusion they are protecting themselves from losing more than they've already lost. This usually results in real losses. Silly statement number 11. I missed that one. I'll catch the next one. The trouble is, the next one rarely works. If you missed Toys R Us, a great company that continued to go up, and bought Greenman Brothers, a mediocre company that went down, you compounded your error. You've taken a mistake that cost you nothing because you didn't lose anything by not buying Toys R Us and turned it into a mistake that cost you a lot. In most cases, it's better to buy the good company at a high price than it is to jump in on the next one at a bargain price. Silly statement number 12. Stock's gone up, so I must be right. Or the stock's gone down, so I must be wrong. If I had to choose one great fallacy of investing, it's believing that when a stock's price goes up, it means you've made a good investment. All it means when a stock goes up or down after you've bought it is there was somebody who was willing to pay more or less for the same merchandise. I've bought stocks at 10 that went to 14 that now if they double, you couldn't buy a Hershey bar with them. I bought stocks at 10 that went to 6 that are now $40. It's what happens to the fundamentals that really counts over the long term.
What's up, everybody? Mr. Zero to Infinity says hello. If you enjoyed listening to the 12 silliest things people say about stock prices by Peter Lynch, then make sure to click that like button. It helps grow the channel to infinity. As always, let's finish this episode with a quick portfolio update. My Zero to Infinity stock portfolio just hit $17,000. Right now, my biggest holding is my cash position, which consists of a little over $8,000. The reason my cash position is so high is because I want to be ready when stock prices sell off from the all-time highs. Right now, investors are 51.7% bullish and 21.8% bearish. I normally like to buy stocks when this sentiment survey is more bearish than bullish. Like Warren Buffett says, be fearful when others are greedy and be greedy when others are fearful. My next biggest position of 35% of the portfolio is Shift4 Payments. I recently sold 26 shares when the stock price jumped on acquisition rumors. Right now, the rumors are ongoing, and there's a chance Shift4 gets acquired in the next few weeks. If that was to occur, I'd expect the share price to exceed $100 plus. As I stated in an earlier episode, I still don't think management will approve an acquisition, but you never know. My next largest position is Penn Entertainment. I recently sold off my shares that had a higher cost basis, and I now own 100 total shares. I am still bullish on the ESPN Bet Sportsbook, and I plan on building up my position from the 10.77% weighting if the stock sells below $15 in the next few weeks and months. Last but not least, my smallest position is FitLife Brands, accounting for only 4.22% of the portfolio. I recently bought 10 more shares, and I plan on adding to my position if the stock sells off. I expect the stock to be more volatile around the time when management reports Q4 earnings. I think the MusclePharm acquisition will initially be a drag on the earnings efficiency in Q4 due to management waiting on the third-party sellers to exhaust their inventory before fully internalizing this online revenue stream. Plus, there were one-time acquisition costs that will lower the total net income in the quarter. Because of these reasons, I think there's a possibility that the stock price will sell down right after the earnings announcement. If there is a sell-off, I plan on buying up some more cheap shares to build up my total position. And there you have it. That's my portfolio update. Let's end it there. Play the music. If you made it this far into the episode, then make sure to subscribe and click that like button to support the channel. Feel free to watch my earlier episodes of how I'm growing one of my stock portfolios from zero to infinity. All my episodes are meant to be watched in order since the stock market is always changing and there are always new trends to be found as the weeks tick forward. If you have a question that you'd like me to feature in a future episode, feel free to email mr0toinfinityquestions@gmail.com or hit me up on Instagram at mr0toinfinity. Thanks again for watching. Let's keep building from zero to infinity. You got this. As always, do your own research prior to making any investments. Read the disclaimer on your screen fully. Remember that all my episodes are for informational purposes only. I am not a financial advisor, and anything discussed on this YouTube channel should not be viewed as investment advice. I am only sharing my personal ideas, opinions, and one of my stock portfolios. You should never take any of this information as guidance for buying or selling any type of investment or security. There are financial risks associated with investing. Peace.